Hello, everybody. Welcome to Zoe's Treasures. My name's Tracy, and as always, here with my husband Noel. He missed this morning show, but he is back this afternoon. Hello, Southern Charm. Hello, everybody else. Etched by Fire, Mercantile Markets. Hello, hello. Tonight, we are going to talk tax. Hello, a bit Dusty. We're going to talk about audit red flags. So everybody's favorite topic. You know, everybody is afraid to get audited, but it's really not that scary. So hopefully by the end of tonight, you're going to be like, oh, I'm cool. I don't have to worry about this. So we're going to go through just what are the common things? What does the IRS look for? What are those red flags for both your business as a Schedule C and from a personal side? Before we do that, if you guys like primitives, tomorrow morning, 8 a.m., we're doing a primitive show. Everything starts at $1. Shipping is $4.50. Everything behind me here, we've got it all set up and ready for the show in the morning. So that is all going to be for sale tomorrow morning if you like primitives. I also have a video. If you go to that show and you open the show up, you'll see a video so you can get a little bit of closer look. Since I do randoms and I do not list, that way you can take a quick look and kind of see what's there. And I always have a few surprises, things I add in at the last minute that aren't in the video. And with that, let's jump right into it. Let's talk about audit red flags. First of all, has anybody ever had an IRS audit? It's okay. Don't be afraid. If you don't want to answer, you don't have to. I have. I'll tell you, I have. I've gone through 2 different IRS audits. Both of them were what we consider, correspondence audits. So they were really simple. They're really not something to be afraid of. What I want to start with, though, is so many people are afraid of the word audit, but really it's because we hear all these rumors and we hear these myths and you know, all these things that people think cause an audit, but it's really not what causes an audit. So a lot of our fear when we hear that word is, oh, they're going to freeze our bank accounts, they're going to take all of our assets and everything we own. And that's pretty rare, extreme case. That doesn't happen in 99% of the audits. So there really isn't anything to fear, particularly as we're going to find out tonight, if we're prepared ahead of time. It's usually just answering a letter or two. It's usually not that bad. As we go through tonight, please feel free at any time to put questions in there. I'm always happy to stop and try to answer questions or clarify a point if there's something I'm talking about and you're like, no, expand on that a little bit more. Always happy to try to do that. So one thing to know, an audit is not a random punishment. It's not like we're just putting a bunch of names in a hat and we're drawing them out to see who gets audited. There's a very systematic approach, a way of sampling the population to say that on how they determine who gets audited. Usually, in most cases, it's due to some type of mismatch of information or a pattern that doesn't make sense. That's really, in essence, what it boils down to and how the IRS selects people for an audit. There's 3 ways really that an audit is triggered. So when we think just high level, and we're going to drill down a little bit deeper, but very high level, there's 3 main ways that audits get triggered for people. The first one is automated matching. And this is when the IRS computer compares some information that's been provided to it, and it compares it to your tax return, such as Whatnot submits a 1099. They send one to you and they send one to the IRS. You complete your tax return. When you send that return into the IRS, the computer is automatically matching up those numbers to see if what Whatnot says and what you say is the same thing. So that's an automated matching. It's not just in 1099s, it's with W-2s on your jobs that you work for somebody else, and K-1s and other types of forms that we also, when we're submitting or people are submitting on our behalf, get sent to the IRS and to us. So that's the first one. The computer just kind of flags it like, hey, something doesn't match up here. Something's not quite right. We need to investigate. The second way that you get picked for an audit is what's called a statistical outlier. So this is when your numbers, and let's think our Schedule C, our business part of our tax return, when your numbers fall outside of a normal range for someone in your business type of category. So the IRS actually has statistical information on e-commerce, on resellers. Even though Whatnot's a baby in the live selling world, and we're only 5 years old here on Whatnot, maybe 6. The IRS already has statistical data that they match up. And let's just say your mileage far exceeds what would be a normal range that the IRS would have. That may trigger something to trigger to say, hey, we need to look at this a little bit more. Now, don't get freaked out about mileage. We're going to talk about it. But that's the second type, statistical outliers, when something just doesn't jive quite right compared to the general population. The third one, and this is a big one, and this is where a lot of people get tripped up, is missing or inconsistent information. So when something's blank that shouldn't be, when a name is misspelled, a social security number is wrong, something's changed dramatically with no explanation. You go from cash to accrual accounting and didn't file the right form with that change. So when something has happened and it's odd that there's no other information to back it up, missing, inconsistent information. A big one, you would be totally surprised on this one. All the years that I did tax returns, one of the most common reasons I would see an audit come through is because when we have married couples that file, you get married, you're newlyweds, usually you're younger, you get married, and you put the husband's name first and then the wife's name on your joint tax return. A few years goes by, I don't know, you change accountants, you go to H&R Block, and then you go to Liberty Tax, then you're going to do it yourself. And for some reason, you decide to put the wife's name first and then the husband's name. Something as simple as that can trip the IRS up. Just switching the order of the names could totally throw the IRS off kilter, and you may get a letter for it. So those are some of the reasons that may, first of all, just trigger an audit. These are kind of the big audit triggers. Then once you start digging into the automated matching, the statistical outliers, the missing or inconsistent information, there's more details about, okay, what exactly are they looking for? And that's what we're going to get into in just a minute here. But the good news in this, it's not that you have to be perfect. You do have to, dot your I's and cross your T's. Absolutely. But you don't have to be, the best person in the whole world. You just have, but you do have a ton of control over what you submit to the IRS. So once we understand, hey, here's the mistakes that they're looking for. Now I know it. I know the mistakes to avoid to reduce my risk of getting audited. You have control over that. So that's the good news, that we have far more control than what we really think we do. And it's not just this random, bad draw of the straw that you get audited. Before we get too deep into details, basic audit stuff here for the IRS, they can generally go back 3 years, okay? So they can go back 3 years. So they're going to look, first of all, at your most recent return. If they find anything on your like if they're auditing the 24s or the 25 returns right now, if they find anything, then they can go back 3 years from that. So know that if you are ever audited and they do find something, that opens the door and allows them to go back and dig in other returns. Part of the reason why we want to make sure we got our ducks in a row ahead of time. That's a general rule for 3 years. If you get audited and they find something that's a substantial income, where a substantial amount of income is omitted, then that opens the door and allows them to go back 6 years. So in general, they find a little mistake here or there, they can say, yeah, you know what, you made a mistake. We're going to open up the last 3 years of returns just to make sure you didn't make this mistake before. If the mistake means you omitted a significant amount of money that you were supposed to tell them about, now you've gone to the next level. You open the door and allow them to audit back 6 years. And if, just if, by chance, you maybe weren't so cool in your prior life and you actually had some type of fraud on your audit, intentional fraud, and the IRS finds that, there is no statute of limitations. They are allowed to go back as far as they want to go. You could be 65, 70 years old, and if they find a fraudulent misconduct on a tax return, they can go back until the very first tax return you ever filed. There is no limitation. So definitely no fraud. Don't recommend. 10 out of 10, stay away from it. Of course, that goes without saying. All right. So let's talk about, now we know what type of audits there are, how far back they can go. Let's talk about not the type of audits, not what triggers an audit, but what kind of audits are there. There's 3 main kinds of audits. The first one is called a correspondence audit. This is the simple one. This is the kind of audit that I've been audited before. It's typically conducted by mail, hence the name correspondent audit. And it's really for the simple reasons: missing information, A small balance may be owed. Maybe there's something funky with the identity they're not too sure of. Those really easy kind of stuff where the IRS is saying, hey, I know you're really not cheating us. You probably made a mistake. Let's just clear this up. I'm going to mail you a letter. You get your documents. You send them back. As long as we can match it all up, all is good. Easiest kind of audit there is, correspondence audit. This is the most common kind. Think about it. The more in-depth the IRS goes with an audit, the more money it costs them, and they may not necessarily recoup that money. The IRS is a business too. They're looking at your return on their investment, right? So they're going to try to do correspondence audits as much as possible. It's no different than us trying to do PWE giveaways because they're the cheapest way to do a giveaway. The IRS is going to try to do the audits by mail because that's the cheapest way. The next level of audit that may occur is what's called an office audit. This is where the taxpayer, you, are going to receive a letter, and it's going to say, Mr. Taxpayer, we've noticed something funky on your return. Of course, they're going to use far more professional language. We noticed something funky on your return, and we need you to come into our IRS office and talk to us. Okay, that's an office audit. You're going to get the letter. They're going to say, hey, I don't know if they give you an appointment time right up front or you got a call, but basically there's going to be a day and time that you're going to have to go into the IRS office with some documentation and go meet with an agent. That's level 2. This usually happens with more complex tax returns, a little bit higher income earners, stuff a little more deeper than just you messed up a piece of information. The third kind of audit, this is the one that kind of gives me a little bit of like, ooh, I don't want this. It's called a field audit. Yes, they bring out the bright light and they sit you in this room with nothing in there. No, it's not that bad. But the third one is a field audit. This is the most comprehensive, I am digging into your records audit that the IRS has. This is an in-person meeting, and this isn't the IRS says, hey, why don't you come see us? This is when the IRS says, I'm coming to see you. I'm coming to your house. I'm coming to your place of business, but I don't trust you to show up. We're going to go see you. That's a field audit. The field audits can last several weeks, months, even can drag on years. The field audit, that's the one where you know you screwed up. That's the one they're going to be digging way back in your records. You probably done something pretty bad. Yeah, that's the mob type audit. Canada, unfortunately, is not a safe haven. You get flagged. You get flagged. You have a hard time crossing the border at that point. So those are the 3 type of audits. The one that is, again, the most common, the most simplest one, the one that if you're audited, you're probably likely to see is a correspondence audit. And they are actually really, really simple. Nothing to be afraid of. Any of these audits, though, the IRS isn't just going to be like knocking on your door. Guess what? You're being audited. It's the IRS. No, they're going to send you a letter. You're going to know well in advance. They're going to give you time to reply. It's not like you get this letter and you have to be at the IRS office at 8 a.m. the next morning. It's not like that. They're a business. They work in a business way. Now, don't miss their deadlines. If they give you a date and time, you need to show up. But they're not trying to get you or surprise you or, do all these things that we think the IRS is so evil and mean. And they're really not. They're people just like us, just trying to do their job and get a paycheck and go home. They're no different than we are. All right, so let's just kind of walk through an example of what may trigger an audit, what that might look like. So let's say you sold $40,000 on Whatnot this year. Whatnot sends you a 1099-K. On your 1099-K, it says $40,000. They also send a copy of that 1099-K to, you can't fool me, no kidding. They also send the 1099 to the IRS. Okay, so now the IRS knows that you made $40,000 on Whatnot. Well, you go to do your tax return and you report $31,000. So your tax return says $31,000. You send it into the IRS. The IRS matching up computer says, whoa, wait a second. Whatnot says you made $40,000 and you're only telling me you made $31,000. Okay? That's where the IRS is going to flag it. You will probably get a letter at that point saying, we have a mismatch of information. Please explain why Whatnot says that you made 40,000 and you're telling me you only made 31,000. A lot of times there's a very simple explanation. This is part of the reason why I do tax education, and we talk a lot about taxes. Tracy made me do it. No, don't do that. You may talk about this next. Even though Whatnot says we made 40, that's not profit, so no one's will be correct. A bit dusty. Actually, that's exactly what my next sentence was going to be. The reason why this may happen, and this does happen very frequently, particularly with 1099s, Whatnot's is gross income. You are looking at your 31,000, which is probably after fees or any other expenses Whatnot takes out. That's what you're pulling out of the app. But what have I talked about a million times? We don't record what we pull out. That's what goes into our bank. That's our cash flow. What do we record for revenue? The 40,000. We record what we earned, and thus we report what we earned. So we should be reporting that same 40,000 that Whatnot's reporting. Okay. At the end of the day, yeah, they took fees and stuff, but we report, we put the 40,000 as revenue, and then we list our fees as expenses, the shipping as expenses, whatever else that they took off to get, that $9,000. That's an expense that goes on our Schedule C. So our revenue on our Schedule C, that top part of the Schedule C, should match those 1099Ks. One of the things that we should do as good business owners, besides keeping our records on a weekly basis, is at the end of the year, when we get that 1099K from Whatnot, eBay, Etsy, Poshmark, Mercari, any of those, we take that 1099K and we match it up. And we say, okay, I show that I had X number of dollars from Whatnot. Whatnot says I have this much. Do they match? If they don't, that's our job to figure out why they don't match. The majority of the time, it's our mistake, not Whatnot's. That's not saying that they're perfect and that they can never make a mistake. But the majority of the time, it's because we didn't record something in our busy life. Because let's think about it. Even though Whatnot's fully capable of making mistakes, they have an accounting department. They have computer systems doing this regularly, keeping up with their accounting for their business the same way we should be on our business. But their systems are probably a little more advanced than what you're using to keep your accounting. So that's a common reason why a Whatnot seller may get an audit, a mismatch of their 1099K information. Cancun, yes, Cancun. Are you going to Cancun? Is that the going to go hide away there? My husband's just like, you're the CPA, you do our taxes. Okay. I want you to put yourself in the shoes of the IRS agent. They are looking at information the same way you would look at information. When you get something, let's just say you place a large order on Whatnot, you're in your favorite seller show and you order 15 different items. When that order comes to you, you open up the box and you're counting. Do I have 15? Is everything here? You're making sure it matches to the packing list or to your records. The IRS is no different. All they're doing is protecting their business by matching this stuff up. So this is one of the things I want really to change a perspective on the IRS, is that they're not the bad guy. I know there's people out here who hate it. Yes, whatever. It's the world we live in, the laws that we obey. They're just doing a job and matching things up. And as long as we understand that, we can design our systems and do what we need to do accounting-wise and tax-wise so that we don't have to worry about it when we send those forms in. And if by chance something gets flagged, as long as we've kept all our records, all we have to do is say, oh, I got a letter, you're asking for this? Sure, no problem. Print it out of your computer or go to your file drawer or take your notebook and you make the copy and you send it back, and it's as simple as that. That's really what happens the majority of the time. So let's keep moving on. We're going to go to the next point about inconsistent records. So inconsistent records raises a ton of flags. What does that mean for us? Your inconsistency tells a story about your business, and usually it's not one that you want the IRS to read. So what does this mean? The IRS doesn't look just at 1 year. When you filed your last tax return, your 2025 tax return in April, or if those of you who have done an extension will be filing it before October 15th, the IRS isn't just looking at that one tax return. I want you to imagine that you pull your financial information off of Whatnot and you stick it into ChatGPT and you're like, hey, look for trends or analyze this and shoot me out some information. If ChatGPT can do that from a Whatnot CSV file that you download, imagine the systems the IRS has to analyze your information. Thank you guys for sharing the show. To analyze your information over a series of years. And they do this. They're not looking at Zoe's Treasure Schedule C for just 1 year. They're looking at Zoe's Treasure Schedule C for 3 or 4 years. And they're looking for trends. They're looking to see that that income is growing, that my expenses are in line with the income, that they're growing at the same rate. They're looking to see, did I take mileage 1 year but not take mileage the next? Or maybe I've never taken mileage and now all of a sudden I have this huge mileage expense. They're looking to see if I'm taking, did I have contract labor 1 year and then no contract labor? This isn't to say that things don't change in your business from year to year, but in general, it's kind of like your household. If you think about your household and you think about your mortgage or your rent payment, your income from your job, the money you spend on groceries, it's kind of the same each year and kind of grows at the same rate, right? If you look at last year, maybe you made $80,000 last year, you're probably going to make $80,000 to $85,000 this year. Your expenses are going to be about in line the same way. Your business is no different, and the IRS knows that. So this is where they're looking for things that happened 1 year that didn't happen the next. So they don't just look at that one tax return. They're looking at a trend of what your business has done over a few years of time. Oh yeah, absolutely do not be late. File your extensions. Don't file late. You will be penalized, and they are not kind about it whatsoever. So we talked about looking across a couple of years. So some of the most, some of the inconsistencies that are the most common that they pick up on are gross receipts that aren't matching the 1099s. So your 1099s over a series of years, they're looking at how that income is growing or not growing. One of the things they're going to look at, maybe your first year on Whatnot, you did pretty good, made 20, 30,000, you filed your Schedule C. But then maybe you had a baby and the second year or something else happened in life. The second year you're like, no, I just need to take time off, and you didn't sell anything, but you're still in business. You should still file that Schedule C because you're still in business, even if you didn't really sell much, but you're like, I only sold $1,000. I'm not going to worry about it. And then the second year you don't file the Schedule C, the baby gets a little bit older. You're like, yeah, I've adjusted this motherhood thing. I'm ready to get back in my business. Now you're in year 3 and you file a Schedule C again. The IRS is going to be going, what'd you do? You filed one, you didn't file one, you filed one. Those are the types of trends and things that they're looking at over multiple years. Expense categories that shift dramatically. So we know our Schedule C, it has the income, and then it has all your expenses. So they're looking at, did 1 year you claim mileage and you had 10,000 miles, and the next year you had 200 miles, and the next year you had 4,000 miles. Now, I'm not saying that your miles are going to be exactly the same, but that's a drastic change if you go from 10,000 to 400 to 4,000. That doesn't make sense. If you drove 10,000 1 year and then you barely drove 400, but your income was the same, the rest of the stuff was up there, that just doesn't make sense, right? I mean, just think about it logically. None of this is like, wow, I never thought of that. All of it makes sense. All of it's logical, where like, yeah, I would question that too if I was looking at it. Now, I know I come at this a little bit different because I have an audit background. So I look at trends, and when I see things, I'm like, well, that doesn't make sense. What happened in this year? And you ask those questions. But you should be looking at that for your own business too. This is one of the reasons why we keep our accounting records on a regular basis. And quarterly, you're looking back over that quarter. So in March, at the end of March, I'm looking over the first 3 months. The end of June, I'm looking at the 3 months and the 6 months, because I'm looking for those trends within the year of my business. So then when you get to the end of the year, you start comparing year over year. And as a business owner, you're looking for those gaps, those ups and downs. That helps us make decisions. It also helps us identify where missing information may be. If I compare 2 of my tax returns and I see that last year I had a lot of mileage and this year I don't, I may say, oh, did I forget to put that on my tax return? Or last year I did home office, but this year I didn't. Those are things that we look at to see inconsistencies and maybe something we've missed. Or if something is really high, maybe subscriptions or something is really high this year, where in the prior year it was low. And I'm like, what did I pay? Did I double count something? Is this correct? So the IRS is looking at it the same way we would as just logical, intelligent business owners analyzing our business. They're just doing it through computers in order to find inconsistencies that may trigger more money that you owe them. Another thing they're looking at, and this is a big one. This is part of the reason I say, what do you need to keep? An income record, an expense record, and an inventory record. At the bare minimum, those are the 3 bookkeeping things that you need to keep. Now, you can get as fancy as you want with them, but those are the 3 minimum. Why? Inventory costs that don't track with sales is one of the things that the IRS is looking at. So this means if you sold $30,000 in goods and only reported $5,000 in cost of goods, that would raise some questions. That would be like, you spent $5,000 to make $30,000. Of course, that would be, either, hey, you're really, really good at sourcing and then selling for a high price, or something isn't matching up here, because that's awfully low cost of goods for $30,000 of income. However, if that ratio was consistent for 3 years, the IRS wouldn't bat an eye. They would be, no, this is the way they run their business. So just because something exists doesn't mean instantly it's going to be a red flag, but you have to think about, does it exist? What's the relationship? What's the trend? Overall, if I step back, I get out of the weeds and I see the whole forest, what is this big picture telling me? What's the story that my tax return is saying? And then you start picking it apart and getting questions on it. Here's the other one, and this is the one that you're going to hear that people quote like it's the Bible. Business losses every year. You will hear, well, if you take business losses for 3 years, then they're going to say you're a hobby and then you're not a business and you have to make a profit in 3 years. That is incorrect. That's not what the IRS says. It is a piece of a much larger evaluation. But one of the things the IRS does look for, one of the things their computers, when they're looking at trends, is continual business losses year over year over year over year. 1 or 2, 3 years of losses isn't a bad thing. The IRS actually expects you to take a loss in the first couple of years of business. That's normal. That's very typical for many, many businesses. But if you're on year 4, 5, 6, and you continue to take losses, and those losses are consistent, every year, 10,000, 15,000, 11,000, 12,000, 9,000. Those numbers aren't fluctuating wildly, but they're just consistent, continued losses. The IRS is going to be like, well, the whole reason somebody goes into business is to make money. You're in year 4, 5, and you have this same $10,000, $15,000 loss every year. Something's not adding up here. Either you just really suck at this business thing, or you're trying to take some losses to offset other income, therefore paying us less taxes. So keep that in mind. What they would be looking for is, okay, I took a loss in the first year, second year, maybe I took a loss in the third year. But if we look at this from a very logical business perspective, your first year loss is probably the highest, and then you probably lose a little. So maybe the first year you took a loss of $10,000 in your business. The second year, maybe it's $5,000. The third year, maybe you're broke even at 0. Then the fourth year, maybe you made $500. Maybe the fifth year, you then took another loss of, $1,000. That's showing that you started with the loss because you had initial outlays at the beginning of your business, but then you were doing business well, you were getting on your feet, and you're heading towards a profit. So that trend tells a very different story than consistent 10 to 15,000 losses even across the board. That's what the IRS is looking at. What story does the trend tell? What story do the ratios the numbers compared to each other tell? One of the things the IRS is looking for is coherence. Does the return tell a consistent, believable story about a real business? Is this cohesive? Your job as the taxpayer is to make sure that it tells a good, cohesive story because it is your business. and it is a business. You're doing what you're supposed to, and you're doing it correctly. So as long as you're doing what you're supposed to and doing it correctly, there should be no reason why that story looks funky. Part of what we do to ensure our story is correct, is we track the same categories. If we start out tracking shipping, software expenses, mileage, home office, packing material, maybe telephone. So we have a handful of categories that we track in year one. We should track those same categories in year 2, 3, 4, 5, consistent categories. And we don't put something under miscellaneous expense one year and then decide, oh, no, I'm going to put that under shipping. And then the next year we go, no, I don't like it there. I'm going to stick it over here under miscellaneous. Why? Then your expenses don't match up. It doesn't make sense. It's not cohesive. It's like picking up a book and reading page 82 and then going to page 300 and then back to page 50 and trying to make a good story out of it. You can't. And that's what happens when you start not tracking things the same manner, the same way, being consistent, not just in our shows, not just in showing up, in our record keeping. That word consistency, I swear that thing pops up in every talk show I ever do. So let's give you an example of what this looks like. So we have some examples here. You claimed $4,200 in mileage last year. This year you claimed $412. That's kind of a funky story. I would say why, right? So maybe you stopped tracking in the middle of the year. You're like, I didn't keep track. I'm claiming less mileage. Maybe there's a very legitimate reason. Maybe your car broke down and you're like, you know what? I didn't drive. I just didn't drive. I had to pay Ubers. There's Uber expenses, whatever it may be. But the IRS doesn't know that. All the IRS sees are numbers on a return. So the IRS is looking at this trend and they're like, well, they claim mileage one year, a whole bunch, and then barely none. So that's going to be like, okay, what's wrong? Then they're going to send you a letter and you're going to say, oh, this is what happened, because you're keeping track, you're making notes. This goes back to when I tell you guys, when you calculate your home office and you're like, it's a 10 by 8 area, take a picture of it. When you figure out how much of your cell phone bill is actually business, when you say, okay, 60% of my cell phone bill is business use. How did you come up with that 60? Write it down. Why? Because when the IRS looks at trends, if your tax return is pulled because a trend doesn't look right, then you can say, oh, no, it's okay, Mr. IRS. This is how I came up with that number. That's your documentation. You're filling in the missing pieces to that story that the IRS may not have. So, y'all are really quiet. Either I'm making a lot of sense or you're all just like, this lady's crazy. One or the other. I don't know. I'm just going to keep going, though, because I'm cool either way. So, taking notes. Okay. I just want to hear what you guys think. I'm about to tell you the answer. Which do you think is riskier for the IRS? Overstating a deduction or understating your income? So putting too much deductions or not telling them how much income you made. Don't be terrified. You are all right on track there. Missing income is far riskier than overstating expenses. Missing income is going to trigger almost all the time. Missing income is the easiest way to manipulate and to avoid paying taxes. Why? Because it's easier to hide something than it is to prove something. So it's easy to come up with receipts where the expenses are harder to fake than the income is to hide. Let me try to say that in a different way. It is so much easier to manipulate, hide, be dishonest, to distort income than it is expenses. So as auditors, we are zeroed in on income. The riskiest part of any business is revenue. So let's just take the IRS out of it. As an auditor, when I go to a business and I go to audit a business, I'm walking through everything they do. I'm understanding all of their systems. Hello, Lilac Bloom. I'm understanding all of their systems, and I'm coming up with Where are the risky areas? What can go wrong in this business? Where is it that I need to zero in at and really start testing things, right? Revenue is so risky that our standards, our regulation, the SEC tells us, and our international financial reporting standards tell us, you cannot say there is no risk in revenue. There's some very few exceptions. But basically, anytime there's an audit, revenue is a risk, and we're doing work around revenue. No exceptions. The IRS is the same way. They're auditors. They're going to look at your revenue on your tax return as one of the riskiest areas for them overall, where they're going to be losing money on their side, where they're not getting paid what they want. So underreporting your income is far riskier, it's riskier to you than claiming too many deductions is. So Whatnot, eBay, Poshmark, they're all required. This is one of the reasons why they are required to send that 1099-K to the IRS. So while we look at it and we say, okay, the threshold for Whatnot to report to the IRS is $20,000. And let's just, in case you're new here, I just want to do a quick little refresher on 1099s. You're a Whatnot seller, and this goes to all the apps, to eBay, Poshmark, all of them. You're selling. As long as if you make $400 in net profit, you are required as a taxpayer to report that money on your tax return. Okay, your obligation to report money is your obligation. Has nothing at all to do with Whatnot or the platform's obligation to send you a tax form. Those are two completely separate obligations. You as a taxpayer must report your income. Then Whatnot as a business is told by the IRS, if the people on your platform reach $20,000 in income and $200,000 in sales, you as a business Whatnot have to let us know and send that person a form to put on their tax return. They are two completely separate things. There are so many times, particularly during tax season, because that's when it's on everybody's mind, that we get these questions. Well, when is it that I have to report? Well, if Whatnot doesn't send me a 1099, I don't need to report it. That's not true. Two completely different things. One is Whatnot's obligation and the other is your obligation, regardless of what Whatnot does. Because here's the deal. If you made $50,000 and you put it on your tax return because you're a good, honest, ethical person and you do what's right and you submit it to the IRS, but lo and behold, Whatnot doesn't do what they're supposed to do and send you that 1099-K, who's getting in trouble? Whatnot, not you. But let's reverse it. You're not so honest and you decide, I'm not going to put this on here. Nobody's ever going to know. Oh, it's Lysandra, not you. Okay. But then Whatnot reports it. Guess what? Whatnot's doing what they're supposed to. They're doing their job that the IRS tells them, but then you're not doing yours. So that's one thing that you always hear mixed up. People think there's some correlation. There really isn't a correlation to that. It's my obligation and Whatnot's obligation separate. So as we said in the beginning, one of the main things that the IRS does is match up this information. The 1099-K that they send in is technically called an information return because it has nothing to do with Whatnot's taxes. It's just Whatnot's providing the IRS with information. So they're filing what's called an informational return. And then the IRS takes that and they match it up to your return. And if those numbers don't match, that's a red flag. That's something that can get you an audit for. Most sellers, and I honestly believe this because I believe in the good in people, don't intentionally underreport their income. Usually it's accidental. It's maybe lacking some of the knowledge that's necessary to report in the right manner. Not recording, not doing their accounting properly, so they underreport because they didn't track properly. A lot of it, these mistakes that happen and these flags that go up is because it's not because they're trying to be fraudulent. It's just because they didn't know or they made a mistake or just didn't do something properly. At one point, is not required to send the 1099. Is there a minimum amount? So yes, Whatnot is required to send the 1099 when you make $20,000 in sales and 200 transactions. So let's just say you made $20,000 in sales, but you only made 100 transactions. You just sold really high value stuff. They're not required to. You've got to meet both of those requirements And then Whatnot has to supply the IRS and you with that 1099-K. So some of the reasons why you report your income wrong, again, not on purpose, but just some of these reasons may happen. You have multiple platforms you sell on. You may get a 1099 from Whatnot, Facebook, Poshmark, whatever it may be. And maybe you tracked Whatnot really, really good, but you didn't track the others very well. So you just don't have good accounting records. That could be a reason why you underreport. Yes, you are. Correct, Slover, you're required to file as long as you have $400 of net profit. So $400 after all your expenses, if you had that hit that limit, you are required to file. And that's because self-employment taxes kick in at that $400 limit. Another reason why you may underreport your income. And the reason why this is important is if we know what the errors potentially could be, then we also know how to prevent those errors. Cash or in-person sales are not recorded. So maybe you're doing event sales, you're doing other types of sales, Facebook Marketplace, cash deals, local pickup. Maybe you have a booth that's cash only. Maybe you have a booth that there's a credit card and you got money coming from PayPal on that and some from cash on this booth. So you have different forms of payment coming in and you're not tracking very well. Therefore, you don't really know what your income is. We go back to the basics. We do accounting so we understand all of our income, our expenses, and our inventory. We know where we've been. We make decisions about where we're going. And then because we've done that so well throughout the year, we can use that information to file an accurate tax return. And if by chance we get flagged for any one of those types of audits, we don't have to worry because we've done that job so well throughout the year. The part that so many new business owners miss is that they think accounting is only to do your taxes. So many people, and I know this for a fact, one, from being in the industry, and two, from the questions I get since I've been doing tax shows. January to March, I will guarantee you I will hear at least weekly, I didn't track my income all year. How do I know what to report to the IRS? Or I'll ask, does your income match your 1099-K? Well, I don't know. How do I find out? Where do I find out how much I made? I about have a heart attack when people ask me in January, February, well, how do I know how much money I made on Whatnot last year? Excuse me? How do you know how much money? Because you've been tracking that all year long, or you should have been tracking that all year long. So this is part of the reason I started doing so many of these shows, is to be like, no, we got to change this. We got to get you prepared. We got to get you to the point where you're making good business decisions and you're ready for tax time. Tax is just like a compliance thing. Tax is like an afterthought. You're doing this because you want your business to succeed. And then we do our taxes, and if by chance we're audited, we're golden. We got what we need. Another reason, and we kind of covered this earlier on in the show, that you may underreport your income is because a lot of people report what they pull out, not what the gross is. So you don't put on your accounting records or your tax return what you pull out of Whatnot. I know many people look at that, whatever they'd say, oh, look at my show's over. Whatnot says I have $2,000 available. I'm going to put that in my bank. You made more than $2,000. You probably made about $3,000 or $3,500, but then they took out the fees, any shipping charges that you paid, any promotions you did, now, and then you get down to that net. So this is one of the big reasons why we get to the end of the year and people say, Whatnot says I made $50,000 and I didn't. Look, I wrote it down every single time and I only made $30,000. Well, yeah, because you didn't record the right number all year long. That's usually what it is. Now, there could be other reasons, but usually I'm pretty spot on what that reason is. Here's the other thing. Those of you who have been in my shows before when we've talked taxes, at the very top of your Schedule C, you have a box and it asks you, thank you so much, Tiny Roots. The Schedule C is asking you, are you doing cash basis or accrual accounting? And you have to pick one of these on how do you keep your accounting records? How are you reporting to the IRS? The majority of Whatnot people use cash. That's fine for the majority of people. But let's think about this. Good evening, Brandy. If you do a sale on December 30th, okay, you do a big whatnot sale. It is a blowout year-end celebration sale, and you made $5,000. There it is right there. Thank you for bringing that up. Schedule C, line F, accounting method. You're going to have to pick one of those. So most of us pick cash. We're just going to go with cash right now. We're not talking about the difference at the moment. So you have this big blowout sale December 30th, and you made $5,000. And you go to pull it out. Let's think logically. If it's on December 30th, the bank is probably closed on the 31st. You're not getting that money until the 2nd, 3rd of January. So you're really not getting that. You didn't earn that money in December. You earned it in January. You earned it when that cash came to you. Guess when Whatnot's going to report it on your 1099-K? The year that you took the money out. The subsequent year, not the year you earned it. They're going to report it in the year they gave it to you. Okay? But you may be like, oh, that's $5,000. I got to write that down. And that goes back to the consistency and how you're recording stuff. We can't be switching between cash and accrual. So we've got to do it the same consistency. This causes confusion at year end for quite a few people. So when I'm looking at, if I have somebody and they say, my records, my income doesn't match what my 1099-K is, the first thing I'm looking at is, what were you recording? Were you recording gross or were you recording net? The second thing I'm going to look at is year end. What did you record around year end? Because usually there's a mistake made around that time period. Hello, Sam Dog. So those are the four main kind of ways that you would understate your income, not intentionally, but just as purely there's some type of mistake made or something wasn't recorded properly. So let's just kind of summarize that and go back to it. It's so important to understand how you're recording your income to make sure that it's all there. One, because it is the riskiest area at all in any audit, in any business, is cash. Revenue, not cash, revenue, the money that's being earned, is the riskiest part of any business when you're looking at analytics, when you're looking at auditing, when you're looking at taxes. And the IRS agrees with that, because that is the part that 9 times out of 10, you're going to get in trouble for underreporting. Do they care if you're taking too many deductions? They do. But it's not the thing that they're really zeroed in on. So it is not that I'm saying go over, make up deductions, but if you're going to make a mistake, it's better to make a mistake on the deduction side than it is on your revenue side. So if you're like, okay, Tracy, I've got to keep a revenue record, my income coming in, I've got to keep expenses and inventory, by all means, if you're overwhelmed, at least make sure that revenue is right. Try to get the rest of them right, but that revenue is just really, really a sticky point. If you don't have records, the IRS will always win 100% because you have no proof. If it's not documented, it didn't happen. If it's not documented, it didn't happen. It's a common theme in most businesses. If you're in the medical field, if you didn't write something in the chart, it didn't happen. When you're in accounting, if it's not recorded, it didn't happen. As an auditor, if I didn't write it down, I didn't do it. I could have spent my whole week working on something. If I didn't document it, it didn't happen. So IRS looks at it the same way. So Karina, you're 100% right on point there. Scuba Stevie-O, hello. One of the reasons, do you suggest using QuickBooks? I have no experience with that. Former kindergarten teacher here using Excel. A bit dusty. I suggest using whatever system you will use on a regular basis. So that really, oh, hey, Dragonfly. It really depends on what kind of person are you? Are you a pen and paper person? Are you a computer person? If you decide to use QuickBooks and you really don't like technology a whole lot, you're going to dread opening up that computer once a week to record your income and your expenses and your inventory. But if you love computers and you like all the fanciness and you like the reports, that may be exciting to you and you're like, yeah, let's do it this way. Using a system, even if it's not perfect, is better than not using anything at all. So whatever system you come up with, a pen and paper, an Excel sheet, a Google sheet, Reseller Genie, QuickBooks, there's other softwares out there. Pick the one that's going to work for you. As a CPA, I can never endorse one over the other. We've actually talked about, my husband's like, well, maybe you should get hooked up with one of these software companies and then you can talk about it. I won't, because I can tell you use QuickBooks all day long. Again, if you don't like it, it's not going to work for you. And I'm like living proof of this. I'm a CPA. I could very easily use QuickBooks. I've used it for 20 years, if not more now. I did it 1 year for my business. It was like, this is overkill. I don't need it, and went back to Excel. I'm doing what works for me, what's easiest for me on a weekly basis. So I got it. Thank you. Last year, I set up my office to support my business. Perfect. I didn't sell anything, but I'm selling this year. How do I deduct my expenses for setting up? So you set it up before you did your tax return. You really can't take those expenses. How much are you looking at for setting up your office? I mean, are we really looking at a lot of money? Is it worth it? How close to the end of the year were you? So there's some technical questions, and then there's some like gray area where we can kind of make it work questions. If you were in December and you were buying some stuff, maybe you bought a desk and a chair and a computer. I had to file an oh, so you haven't filed yet. You haven't filed your 2025. So you bought this stuff in 2025. Oh, then you're golden. Go ahead and you started your business. Heard nothing. Yes, no. If you haven't filed your 2025 tax return yet, this is an easy question. Create your Schedule C. You're going to add a Schedule C to it. And the date you started business is the date you bought your first piece of equipment, chair, computer, whatever stuff you bought to set up your office. And then you just record it as normal. So you have a Schedule C. Maybe you have no income that year. If you didn't sell, that's fine. You're going to show a little bit of a loss. No problem. You go into this year and you just continue on. Super easy. So now that's a time where filing an extension really, really helps you out there, because now we're here and we can answer this question and be like, yeah, let's just do this the right way. So, okay. Let's think. Everybody's heard loss aversion, right? It's a term that I've used a lot. Green 13 uses it. Okay, I'm curious how someone deducts a private collection if considering selling. Depends what the collection is. The IRS is very, very particular and specific about what they consider collectibles. So my first question would be, what is your private collection of? And I don't even have the whole list memorized. I'm just hoping you give me an answer that I recognize on the list, actually, if I'm being completely honest. Your feet pics are not collectible, at least not yet anyways. Antiques and jewelry. Yeah. I'm pretty sure those are on the list. Okay, so collectibles, if they truly were a lifetime collectible and you are selling it, those are like investments. So collectibles are considered, you can't just switch them into business assets. Those would go on a Schedule D, not a Schedule C. They're looked at the same way as like a stock would be looked at. They're looked at something that appreciates in value. You have a cost basis in them, and then you sell them at a later date. So collectibles are quite a bit different. Now, if we want to and it kind of depends too. The amount of collectible you have, the dollar value. I mean, did you seriously like make this a huge collection, or was it just, I'm going through life? Husband bought me some cool stuff. I was on vacation, bought some pieces of glass, some jewelry. This is just my personal belongings, or was it truly a collectible? Let me give you an example. I have a very good friend of mine. I've known this gentleman for 30 years now. He is a huge Mets collector. He is actually the second largest Mets collector at one time. He may not be anymore. About 10 years ago, the second largest Mets collector in the country. And when I say Mets, I'm talking about the baseball team. And you want to talk about jewelry, cards, uniforms, you name it, he had it. To the point where I would actually help him inventory his Mets collection every single year, and it was privately insured. That's a collection. That can't just be transferred into a business asset. Art's collection, wine can be collections. So the antique jewelry is kind of bordering. This is one that, you would probably really need to sit down with a CPA and have some good documentation. If it's truly a collection, you have kept all of your receipts, you can justify the cost basis, because you don't do collections and not know what you put into it. That's part of the, it's not documentation. What is it? Provenance of the items. It's part of the history of the items. So there you go. Thank you so much. Any work of art, rug or antique, but again, we have to look at provenance and stuff. We have to look at, is this truly a collection, or was this just a few pieces that you picked up in the normal course of life? Metal or gems, stamps, coins, alcoholic beverages, which usually relates to wine. Sometimes whiskey or gins could be collectibles. Tangible property IRS determines collectible under 408M. So that's the IRS list of what's considered collections, and they are taxed very differently than business assets. You're getting into territory where you probably want a professional to help you. I hope that, I know it's probably not the answer you're looking for, but it's probably the best answer I can give you. I am going to pin this up here too. I am going to pin this. We do have a library full of different guides that talk about, there's templates in there, there's guides that talk about all kinds of taxable issues. A lot of the stuff we're covering, accounting concepts, Schedule C's, like kind of everything that surrounds the whole accounting tax area of your business is included in there. In addition to what's included in there are all of my show notes. So I do 2 shows, Business in the Morning, Tax, every Friday, and all of our notes are included in that library too. So I'm just going to leave that pin there. You are very welcome. I wish I could like give you a little more, but sometimes it's like, I've got to know too much. I've got to know so many details that I can't really answer here. Pardon? Okay, that's fine. I had someone ask me to put an item in my marketplace. I've never done that. How can I? Oh, that's super simple. So if you're in a show, you can put it in your bin. Or if you already have a listing for it, you just go to that listing in your inventory tab and you just make sure that it says active for the marketplace. And then it's there in your marketplace. So they can just go and buy it.
I know most of us are used to purchase stickers to rewatch. We don't sell the stickers to rewatch.
I mean, you can buy stickers. Please don't. I mean, if you want to buy them, feel free. I'm not going to stop you. But if you want to rewatch, you can always rewatch for free on Zoe's Treasures YouTube. So I don't want you to spend money just to rewatch, because you can do that for free. Okay, so we've talked about loss aversion before. Loss aversion works both ways. So most sellers fear deductions. When we think about our tax return, we're afraid to take deductions such as home office. There's this huge stigma. It was around for many, many years that taking the home office is a red flag. It's not. That, I don't know where that came from, but that's not true. But we have a lot of stigmas around deductions and a lot of fear. The reality is actually that's opposite. So a return with no deductions or not enough deductions is actually a bigger red flag than taking the deductions that you legitimately deserve to take. So thank you, Liz, for helping. I appreciate that. So don't be afraid to take the deductions that you legitimately should be taking. If you're doing your accounting right, tracking all of your expenses, there's no reason why that can't transfer to a tax return. By being afraid, they're like, oh no, the IRS is going to think it's too much mileage, or the home office is going to red flag it, or I shouldn't have put this on my tax return. If it's legitimate and you're following the IRS rules, take that deduction. Don't be afraid to take it. And this, I think it's more generational. I know my generation, there was a lot of stigma and a lot of stuff about taking deductions on your Schedule C. As time goes on, maybe the younger generations don't feel that anymore, but it is something that's still out there. So I want to make a point of, if you've tracked it, you have the receipts to document it, it legitimately happened, then you can put it on your tax return and feel comfortable doing so. By not doing so, you are actually causing them to look deeper at your situation than what they need to do. Part of what we do when we fill out our tax return is the compliance. Is like, hey, I'm just reporting all this stuff. But the other part is being smart about it and reading that story I was talking about. Because it's like you don't want to do stuff that's going to raise questions. You don't want them to ask any more than they need to ask you for. When I would go into places to audit, there's this whole thing about don't talk to the auditors. Don't give them any more information than what they ask for. And the same thing is true kind of with the IRS. We fill out exactly what we need to fill out, following the rules and truthfully, and leave it at that and let it be. Usually it's a safe measure. It's usually a safe way to do things. Never talk to the popo. That's just, yep, never talk to the. Honest, you want to hear a true story about when I was auditing? My boss was crazy though. This was a long time ago. This guy was out there that I worked for. It was a very small firm. There's three of us. It was him. He was a CPA. It was while I was still in school studying to be a CPA. And so I was working for him. And then we had like a bookkeeper or two. So a very small firm. Well, we would go and audit this bank. And look, people don't like auditors. I've been in a profession where you walk into a place and they're like, oh, the auditors are here and they're hiding. They don't want to talk to you. He would legit tell me, he's like, go sit in the stall in the ladies' room and hear what they say about us. I'm like, dude, I don't get paid enough to do that. Like, I'm not going to go sit on a toilet to eavesdrop on people. But this was like the whole thing of they don't talk to the auditor. So if you go in the ladies' room, that's where they're going to go to gossip. I'm like, you're crazy. You're freaking crazy. True story. I've worked with some weird people. Okay. Clean systems reduce stress. So let's get back on taxes. Clean systems reduce stress. I keep saying it over and over. You do what you're supposed. It was really crazy. You do what you're supposed to. You're keeping your records. You're tracking your income, your expenses, your inventory. You don't have to worry. If an audit doesn't have to be terrifying. You get a letter. The letter says, hey, we're questioning your mileage expense. Can you send us a copy of your mileage log? And you're like, oh yeah, guess what? I kept my mileage all year long like I was supposed to. Let me go make a copy of that. Here you go. End of story. It's really that simple. It surprises me the amount of people who don't keep their records. And they're the same ones who are afraid of an audit. The people who don't keep accounting records are the same ones who are saying, I'm so scared of tax season. What? There's nothing to be scared of tax season for. There's nothing. It's the same time every year. It requires the same documents every year. It's kind of like Christmas. It's kind of like, hey, it comes the same time. We know exactly what to expect. We know exactly how long it's going to last. We know exactly what they want. I mean, like they put it all out there for you. We know it. It's not like we wake up January 1st and the IRS puts out a list that says, okay, this year, this is what we want. No, we know it. Prepare for it. Keep your records. Clean systems is going to reduce your stress all the way through. What does audit-ready documentation look like? So we're talking audit red flags. So what do you need to keep besides for your business? Audit-ready documentation. Surprisingly, sounds a lot like the accounting information I tell you to keep. Imagine that. Income. Every sale recorded, platform name, date, and amount. That income reconciles to your 1099s. That's audit-ready income documentation. Audit-ready expense documentation. An expense in a consistent category. That means when you buy boxes, you're always putting them under shipping supplies, not under miscellaneous, shipping expense, I don't know what this is, and shipping supplies category. It's always under the same category. Every expense in a consistent category. Your inventory logs are maintained the proper way. You record shipping, platform fees, mileage, home office, and you have a receipt or some sort of a record for your each and every expense. What do you suggest in looking for a good reseller accountant? I'll be filing for this year. Brandy, first of all, I don't think that you need to look for a specific accountant that does in reselling. Accountants, CPAs, accountants, let me just kind of lay the stage on the progression. You have bookkeepers. They're generally sometimes, and I don't want to say this isn't like a hard and fast rule. Bookkeepers usually have what's it called, like associate's degrees or no degree. They're more entry level and they're just processing transactions. Then you have accountants, usually have some type of like a bachelor's degree, and not always. Again, this is kind of general. Usually an accountant will have a bachelor's degree, a little bit more accounting knowledge. They process higher level transactions. They do financials. They're a little bit higher level. Then you have CPAs. CPAs in most states have a bachelor's and a master's degree, and you have to sit for 4 exams and pass those exams. They're incredibly hard. They're harder than the bar. All your lawyers out there rolling your eyes, I know you are, but CPA is harder than being a lawyer. That's a fight that's going to happen between the professions for forever and ever. And they can be auditors, they can be tax professionals. Then you have what we call like enrolled agents. These are people that have studied specific courses and have taken tests to pass to do taxes. So they're more tax focused, and they are, I don't want to say certified, but recognized by the IRS as an enrolled agent. What you're looking for could be any one of those. And they don't have to be specific in resellers. Why do I say that? Because your Schedule C is the same Schedule C that if you're an Uber driver, a reseller, a hairdresser, a babysitter, or maybe providing childcare services, multiple businesses use the same Schedule C, the same expenses, the same tax code. So the people that are advising you don't necessarily need to specialize in reselling. They need to understand the tax code and how that Schedule C works. Then from that, they should be able to ask you pointed questions by using that Schedule C. Did you have any expenses like this? This is what it may look like in your business. Having said that, I do have, because I've been in this world for a long time, and the accounting world, I'm just going to put it out there, for the longest time was run by old white guys. It's just the way it is. Go to a lot of regional firms. That's who you're going to see in leadership positions. And I say this as a woman trying to make it to the top in an accounting world. This is who runs accounting. There are still, in this day and age, a big group of old guys leading accounting firms. And when I say old guys, I'm talking they should have retired 15 years ago. You just may want a little bit younger of an accountant who understands e-commerce. They don't have to necessarily be savvy in reselling. But if you've got an accountant that only knows how to use paper and pens and never turns on a computer, maybe that's not the one I want to help me with my online reselling business. So it's not necessarily that they need to know reselling, but just kind of think of the qualifications as like a whole, if that makes sense. Yeah, total. It's a whole thing in the accounting world. Okay, so expenses. So we're keeping our receipts, where we bought it, how much we bought it, what it was for, and we're documenting them consistently. Shipping supplies are shipping supplies always. We don't start messing things up. Mileage. Here's the trick for your mileage. Contemporaneous. Now I can't say it. Contemporaneous, which means a log that occurs in real time. As you drive, not while you're driving, but once you stop, write it down. Put it in your phone. Use an app that records it automatically. It's happening as it's occurring. That's the type of log you need. Not, oh shoot, it's January, I didn't record my mileage, let me get out and write something down really quick or create a spreadsheet. That's not contemporaneous. The IRS specifically says that log should be done in real time. Now, for those of you who are like, it's August, I haven't done this at all, go back, recreate it to the best of your ability, and note that, hey, first year in business, I didn't do this. I became educated and learned about this in the middle of the year. I recreated it. Odds are you're not going to be audited. Odds are nobody's ever going to ask you for it, and it should be okay. But if they do, you're honest about it, and you say what happened in your first year in business. Usually they're pretty forgiving, as long as you're not doing some crazy high, extra mileage. So, mileage log. Home office. When you figure out your home office, and we're talking about what are audit-ready documentation is what we're talking about. Your home office, whatever that square footage is that you're using primarily for your home office, you are writing it down how you calculated it. You're like, oh, it's an 8x10 room. That's easy enough. That's my square footage. But you're also taking a picture of it. And if you have more than one space, you're recording. It's an 8x10 bedroom and 3 feet by 6 feet in my garage, the far left corner. You're writing down how you got to this information, because if you're audited 2 years from now, you won't remember. There you go. And a bit dusty, then that's fine. Take a few pictures, figure out that square footage. I use my whole basement. My whole basement we have now converted into our studio, storage space, the whole bit. So totally realistic to do that. You don't need accounting software to be audit ready. I'm going back to what works for you. Pencil and paper, Excel, Google, accounting software. It's more important that you're doing it on a regular basis versus doing it perfectly. I would much rather you miss a deduction, have something wrong, than not do it at all. And if you are doing it on a regular basis, the odds of you getting something wrong are far less than if you don't do it and then try to recreate it. So the key is pick a system and do it consistently to be audit ready. I'm going to talk about the odds of being audited here. I've got some notes in the back. Yeah, I have those. So you can understand what a slight chance there even is that you're going to get audited. I actually have percentages to tell you. I want you to ask yourself one question. Look at your accounting system, look at your bookkeeping system, and ask yourself, if I got a letter from the IRS today, could I respond with it with the proper documentation within a week? Who can say yes to that? If you got a letter on your 2025 taxes today, can you respond with the proper documentation within a week? We have one brave soul. Reclaim Relics, thank you so much. One brave soul today. If the answer is yes, your system is working pretty good. Keep going. Good job. If the answer is no, your system needs attention. That should be what you focus on. Pay some attention to it. Possibly not. Okay. So if the answer is no, you are not audit ready. You should make sure you're getting your records in order. Not that I think you're going to get audited, but again, we don't do this for being audited. We do this for ourselves as business owners. Okay. Let's talk about patterns. We kind of talked about this in trends. Well, very good. Thank you so much. I'm glad you're here. The IRS doesn't audit a single year in a vacuum. We talked about how it looks for patterns and trends. It has data for all these different businesses. And it's going to look at, one of the things the IRS is going to look at is going to say, okay, the first year in business, let's just say you made 100,000. I'm going to keep this easy to do easy math in my head. The first year you filed a Schedule C, when do you need to claim after payout? When do you need to claim after payout? I'm not sure what you're asking. When do you record? Are you asking when do you record your money in your books? Try to rephrase that so maybe I can understand it and answer the right question, because I'm just not quite there yet. I'm going to keep talking while I watch for you to put something more in there, Debbie. Let's just say you made $100,000 the first year in business, and all of your expenses equaled, $60,000. You have 40% net profit on that, right? 60% was your expenses. 60,000 of 100,000. Your expenses totaled $60,000 of your revenue. Then you go to year two. If in year two you make 100,000 and all of a sudden your expenses are 90,000, now it's 90% of your revenue, that's an inconsistent pattern. The IRS is going to be asking, you made no more money, but you spent a whole lot of more money. That doesn't make sense. So in addition to trends year over year, they're looking at patterns. They're looking at ratios, at does your income stay consistent with the expense? Because those two things are in line with each other. As your income goes up, so does your expenses. If your income remains the same, your expenses are remaining relatively the same too. So they're looking at ratios among numbers also, which is the exact same thing as a business owner you should be looking at on a monthly and quarterly basis. So come year end, that's no surprise. You already know if your ratios are screwed up and you should be fixing something in your business, because that's the first sign that you're not recording stuff properly, or you're not making enough, or you're spending too much. When do you claim after you get a payout? So expect cash flow, inventory. Okay. I think I understand what you're asking, that you're doing a Whatnot show and you sell a bunch of stuff, and then Whatnot says, you do all your shipping, and Whatnot says, hey, I've got some money for you. And you're like, okay, let me pull my money out. Do you claim what is being held? Okay, got it. Now that makes a lot more sense. So no, if Whatnot hasn't made that money available to you yet, let's go back to what cash basis versus accrual accounting here, because that's really the core of your question. And I may be getting a little deep, but hang in here. Typically, most of you are going to file cash basis accounting. On your Schedule C says cash or accrual. Most of you, 99%, is going to pick cash. This means that money is not yours until you physically withdraw it from Whatnot. That's when you record it. So you do a sale on Friday, you ship by Monday, your money becomes available, I don't know, Wednesday in your bank. You pull that money out of the bank. You earn that money on Wednesday, not on Friday when you did the show. That's cash. Okay. So what you're asking is, do you claim what is being held? No, that's accrual. So the way you're looking at it is, I earned this money on Friday, even though I may not get it in my bank till Wednesday. Accrual accounting says I record it when I earned it. It's money due to me. It's an accounts receivable coming to me. So Debbie, I would say cash. I would guarantee if this is your first year in business, you're probably going to do cash so that you don't claim that money as yours till you get it. If you are doing accrual, it's probably because you have an accounting background. And then we can have a conversation offline about the best way to do that. But I would assume you're doing cash. Okay. So we're talking about patterns. We're talking about those ratios. I'm sorry. If I didn't answer that question, like if you still are like, I'm not too sure what you're saying, let me know. I'll try to expand more. Always, you guys do that. If I answer a question and you're kind of like, Tracy, that didn't make sense, tell me, and I'll try to keep talking. Sometimes if I just keep talking, eventually it comes out the right way. So the patterns that draw scrutiny. So we know the IRS looks at trends and patterns. What trends catch their attention? What patterns makes the IRS go, this is what we want to think about. Consecutive years of net losses. We kind of talked about that back in the trends. It's okay to take losses multiple years in a row, but if it's always a loss, watch out. Be careful. You need to be able to explain why you can never seem to make a profit in your business. Why? Because you're bordering on hobby versus business rules at that point. So it's not bad. There's nothing saying that you cannot take multiple losses year over year, but there has to be a legitimate business reason why that's happening. And just understand that after a while, if there's continued losses, that does become a flag that you may get questioned. We go back to our documentation. As long as we can explain it, you're probably okay at that point. High expense ratio. So this is what I was just talking about. If your claimed expenses consistently represent 90% or more of your income with no clear explanation, that's outside the norm. What does this mean? I make 100,000 and every year I make about 100,000 and every year my expenses are about 90,000. That's not a business model. Businesses are there to make a profit. If your expenses are super close to where your income is and there's no profit, after a while that becomes a pattern and the IRS is going to be like, are you really in business? What are you trying to cover up? What are you trying to hide? Because a real business is going to try to keep their expenses low and their revenue high, so because their profit comes in the middle of that, right? So we're looking at that correlation between our expenses and our revenue. So is the IRS looking at that. Another pattern that's going to catch the IRS's attention: deductions that appear suddenly out of nowhere. Claiming a home office for the first time after 8 years of being in business. The IRS is going to go, you never had a home? You never claimed like rental expense for an office that you were renting. And all of a sudden now you have a home office? Why now and not before? So stuff that just appears out of nowhere, they're going to question. They may not question, but it may raise an eyebrow. And if there's enough other stuff, then you may get a correspondence audit. Or maybe you're claiming a large vehicle expense in a single year with no prior history. So sometimes these things happen and they're very explainable, and that's okay. But look at it from their perspective. These are just things that make you go, Anybody here have teenagers? Throw something in the chat if you have a teenager or have ever raised a teenager. Okay? You know, teenagers are wonderful at this. I don't care how wonderful that teenager is, how perfect a kid that is. There are things that teenagers say and do that you go, you want to try telling me that again? Are you sure? It's the same with the IRS, except that you're the teenager and the IRS is looking at you asking those questions. Okay? Can you relate to that? That sometimes you just look at your teenager and you're like, why don't you try telling me what happened again? Let's practice this a little bit. Okay? Same thing. Here's another pattern that the IRS picks up on that could be a red flag. Sharp income drops without any explanation. Okay? There could be very valid reasons why. No, you don't have to track hours. Why would you track out? Okay. You don't have to track hours for your accounting in general or for the IRS. You may want to, there's no requirement to, you may want to take a look at your net profit at the end of the month and know how many hours you put in to ask yourself the general question, is there a return on my investment? I have put in X number of hours this month and here's my net income. Is this business worth it to me to continue? I know, and Liz, I've used her as an example before. What Liz like, she was in here earlier. She talks about this openly in her show, so I feel okay repeating it because she's put it out there publicly. When she came back on the app and she was doing her clearing out her basement, selling everything for $1, one of her decision-making metrics was, I'm going to do this, and if at the end of the month, I can make a set wage per hour that's higher than what I would make going and working at Walmart, then I will continue to do this. I will do this for another month. So she was tracked. She was probably looking at some sort, hey, I put in 20 hours this week, 10 this week, whatever it was, and looking at that metric at the end of the month to make a business decision on whether this business for her was profitable enough, or she was like, nope, I'm going to go get a job. So while you don't require it, you may want to look at it. Now, I don't track my hours per se, but I have a general idea of the time I put in, and that's definitely something I look at every single month. Is there enough return on this? Am I making enough money to make this worth my efforts? So sharp income drops without an explanation could be a trend that the IRS picks up on. This could be very explainable. Maybe you're doing Whatnot, eBay, and Poshmark, and you're killing it, but you don't like the way Poshmark is going. So you're like, I'm going to pull off Poshmark for a bit. I'm not doing it this year. And your income drops because you've decided to drop a platform. There can be very legitimate and valid reasons why you can have sharp drops of income on your tax return. Document it. When you're doing your tax return, all the IRS sees is a piece of paper with numbers on it. They don't know why, but they will notice that your income took a big dive. So how do you document it? With your receipts or in your computer, I always have one like Word document that I'm keeping notes on. Hey, income dropped drastically because I did this. This expense seems odd because of this. Anything that's an outlier, anything that looks weird. If I need pictures on something, if I need to document how I came up with the percentage of my phone use or my utilities or my how I calculated my home office, that's a Word document that goes in with all my electronic tax files just in case I'm ever audited in the future, because I will not remember any of that stuff. So just because it happens doesn't mean you'll get audited, but they are trends that the IRS is looking at. Document those trends. You should already know why you may have a sudden drop in income, or why there's some expense that looks funky, or why some big expense just showed up on your books. You know why. You're the one who is recording this on a regular basis and either made the money or spent the money. Take 2 or 3 minutes when you're doing your tax return or through the course of your normal accounting and just write down why. You should be doing, and it really shouldn't take, when I say 2 or 3 minutes, That's all it should take, because if you're doing your accounting on a weekly basis, on a monthly and quarterly, you're doing a review of the month and the quarter, you already have identified drops, spikes, trends, things that are happening in your business. And hopefully you're like, okay, well, why is this trending this way? Why is it doing this? And you're using that to make decisions. You already know this. It will literally take you 2 minutes to write it down. So the solution for your audit ready documentation, your solution to kind of protect yourself from all these patterns and everything, consistency and documentation. It's the same stuff. No matter what I talk about, I tell you the same thing. Be consistent, document everything. I think every week I say those exact same words. So confidence comes from that preparation. So track weekly, not annually. Don't wait till the end of the year. Set up an accounting system, simple accounting system. Do it every single week. Spend some time at the end of the month to review what happened. Reconcile your 1099s. I'm going to do in November, you guys, I am doing a full get ready for taxes. In November, I'm doing a workshop 4 weeks every Monday night about getting ready for tax season. We are going to walk through exactly step by step, how do I reconcile my 1099s? We're going to go through a whole Schedule C. We're going to go from start to finish. So if you're even like, I'm a little bit nervous, I'm not even sure what to do with my tax return, get your accounting in order now. Come November, come to the workshop, and we're going to walk through that whole thing. And you're going to be able to fill out most of it. You're not going to be a full year in because it's November, but you're going to have a really good idea and be very, very comfortable going into tax season. I did the same thing last year, but I did it late in the tax season. So this year we're going to do it in November, and then we'll also be repeating it again, probably February, probably mid-tax season time. I source on Sunday, I go an hour away, can you write off your gas? So Stephanie, that's a really great question. What you're asking is about your automotive expense, mileage expense. You have 2 ways that you can take it. The IRS allows you to pick which way you want. You have actual expense or you have mileage, one or the other. So actual means, just like it sounds, you're going to keep track of your gas. You're going to keep track of all the repairs on that vehicle, the new tires, and when you got brakes, the oil changes, the insurance you paid to insure your vehicle. You're going to keep track of all the expenses that surround that vehicle. And then you're going to say, okay, I have driven X number of miles for the year. This is how many were business miles. That's 40% of my driving was business. So now 40% of all of those actual expenses become tax deductible. That's one way. That's a lot of recording. That's a lot of keeping track, right? I don't want to keep track that much. The other way is the IRS allows you a set mileage amount. There's actually 2 different rates this year. I'll say that what those are in a second. And all you have to do is write down the date that you went somewhere, why you went there, and the mileage you drove. And you can just take mileage. So the IRS allows you for the first 6 months of this year to take 72.5 cents per mile. For the second 6 months, July through December, they have increased that to 76 cents a mile. I think those are right. Those are off the top of my head. I'm pretty sure that's right. I may be off the center too. Can you look that up for me really quick? So that amount that they allow you to take is in lieu of, it just covers. It says, okay, you don't have to keep all these receipts. That 72 and 76 cents covers all your gas and all of this stuff. So you could pick which one you want to do. I hope that answers. So it's not necessarily writing off the gas. It's you're tracking all of the expenses on one or the other. This isn't a accounting entry. You're not putting this on your books as you go through day by day or week by week. This is one of those entries that only go on your tax return and helps reduce your taxable income. What was I talking about? Audit ready habits. We talked about reconciling, taking all the deductions that you're entitled to. Don't be afraid of taking everything you're entitled to take. You want to make your taxable income as low as you possibly can. I agree with you. Wanda, I use mileage. It's so much easier and it's far more effective for me. I get a higher deduction amount from using mileage than I do from actual. So, but you're allowed to figure it out and take which one you want. Now, there are certain rules. If you have what they call a fleet of vehicles, usually on Whatnot that doesn't apply, so I don't talk about it. There are a few special rules, but in general, most of us qualify for either one of those. Here's the other thing that most people find to help them be audit ready, have everything in line, is 76. So I was right. So it's 72.5 cents is the mileage rate from January 1st to the end of June. From July 1st to the end of December, it's 76 cents. There are two different rates this year. This is historic. This is only the second time in IRS history that they have ever had two different rates in the same year. They changed it in the middle of the year because gas prices are so crazy expensive, and they recognize that fact, and we're trying to give a break to small businesses. That's the exact reason why we have two this year. The last time they did this was, it was either 2002 or 2011. It was quite a while ago. The other thing to do to be tax ready is, if you do not feel comfortable doing your own taxes, work with a qualified professional. And there's many ways to do this. You don't have to pay CPA prices. There are CPAs that work at H&R Block that work with small businesses that are, they're like the next level up. It's a really good option. Don't discard it because it's H&R Block. The other things you can do is you can go to a local accounting firm. There are many accounting firms that just have like one or two CPAs and a bookkeeper or two. They are far less expensive than larger firms are. You can get an accountant. You can get a really educated bookkeeper that can help you work through a lot of this. The other thing, come tax season, I will be offering some consulting services. I am not allowed to do taxes. There's an independence issue with my full-time job, so I can't physically sign a tax return and take payment for doing a tax return. I'm not allowed to do that, but I can consult. So I will be offering some time where if you want to do your personal return, and we can sit on a Zoom call and walk through it, and you can ask questions and be comfortable with what you're submitting, I'll be offering that during tax season at a very reasonable rate. So that's something to keep in the back of your mind also. I am a firm believer that most businesses, Schedule Cs, individuals and Schedule Cs can do their own tax returns if you're keeping your records properly throughout the year. The one time that I absolutely recommend that you work with a professional is just keep coming back. I'm going to announce it. It'll be in my bin. It's all going to go through Whatnot. I'm not doing any off-platform funky stuff. It's all going to be legit. But the one time I really do suggest that you do work with a professional is your first year in business. There's a lot of decisions to make that first year. What type of accounting you're going to do, how you're going to account for your inventory, understanding the difference between doing actual expenses versus the simplified methods that the IRS has. There's a lot of decisions in that first year that affect subsequent years. So I highly suggest, particularly if this is your first year doing a Schedule C, even if you don't pay them to do the return, to go and sit with a professional to ask questions and understand it. That's just a smart business move. And I'm not saying it doesn't have to be me. I'm not doing this to try to drum up business. In general, it's a smart move to, if you're like, okay, I'm going to do it, but there's a lot of things I haven't touched before, to become educated on it before you do it. And with that, we're not. I wanted to give you some stats because I wanted to make you guys feel a little comfortable about the odds of being audited. So I wrote some stats down here. Okay, the first one is higher income individuals are more likely to be audited. And I'm going to give you some statistics. And when I say higher income, 4% of all people making over 10 million are audited. 4% of people making 10 million or more are audited. People making less than 25,000, do you know how many returns of making less than 25,000 are audited? Less than 0.5%. It's somewhere around 0.3%. Not even 1%. So if you're making less than $25,000, your odds of being audited are way down there, like 0.3, okay? Where it starts to go up, it kind of goes down again. Where it starts to go up, it gets around the 500,000 mark, you'll start to see an incline. So when you start making around 500,000, your odds of being audited start to drastically increase. Up until 500,000, your odds are less than 1%, or less than 0.5%. So don't think about it like this. Is the IRS really going to invest the time and effort to somebody who's not making a lot of money? You can't pay them. Like, there's nothing there to get. They're going to go squeeze the big apples. So they want the biggest oranges to get the most juice out of, right? They're going after people making 500,000 or more. That's the ones that are getting audited the most. Everybody else, there are a lot of these correspondence audits. There are a lot of, hey, these numbers didn't match up. Copy your record and send me back a letter. That's what you're going to see. 5 biggest reasons why people are audited. 5 biggest reasons. Missing income. Large swings in income. Yeah, you can't get blood from a turnip, and the IRS knows that. They're going to put their time and effort where they're going to get money. Just like us as business owners, we're going to put our time and effort where we're making money. So 5 biggest reasons why you get audited. And this is from Charles Schwab. So this information right here that I'm getting from was from Charles Schwab, which is a large investment company. Missing income, large swings in income, 500,000 one year, $10 the next year, whatever it may be, huge swings in income. Business losses, like what I was telling you before, excessive business losses, questionable deductions, and undervalued assets. Mainly, the 5th one mainly applies to like estate stuff, not really whatnot. It's not surprising. This study from Charles Schwab, missing income, aligns with all the other information that missing income is the biggest #1 reason for an audit. And then I had a couple other statistics here. That's for businesses. Now for personal, just for us as people, our 1040 tax returns, top 4 reasons why your tax return may be audited that has nothing to do with your Schedule C. So this is bonus here, not business stuff, just personal, okay? Can anybody guess what the #1 reason for personal audits are? I can't say that I'm surprised because we've got a trend going. We got a theme here. Nope, not filing. Not reporting all your income across the board. Not reporting your income, whether you're personal, whether you're a Schedule C, business, personal. The IRS is focused in on that income. It's not reporting all your income. So personally, foreign accounts and not reporting your foreign accounts properly. That's the 2nd biggest reason why people get audited from the IRS. The 3rd biggest reason why people get audited, excessive business tax deductions. This goes back to the ratios, the trends, the patterns that we've spent some time talking about tonight. It's not the fact that you took the deduction, it's how that deduction lines up in the big picture. What is the story that's being told? The 4th reason why personal returns get audited, returns with high earnings. That supports the Charles Schwab data, those 500,000 and more tax returns, $500,000 and higher, returns with high earnings, they're going where the money is. They're following the money.
Thank you for the purchase
Thank
of
you.
the stickers. But if you want to rewatch, you can rewatch for free.
So from the IRS website, it says from 2015 to 2023, so a span of about 8 years, because we're looking at 8 years of tax information. For people making less than 500,000, only 0.13% were audited of people making less than 500,000 for 8 years. So they just looked in aggregate. That's from the IRS, which kind of goes in line with what Charles Schwab was saying. So I'm going to leave it at that to say, we're going to bring this full circle. We're not doing our accounting for taxes. We do our accounting accurately, ethically, to the best of our ability so that we can be smart business owners, so that we can make good decisions. Then at the end of the year, you have, did I say 5? At the end of the year, you have a tax responsibility, and you use what you have done all year to meet that tax responsibility. If you're doing what you're supposed to be doing, you have nothing to worry about at the end. It's kind of like whatnot. You put it in the right way, it's going to ship the right way. You do your accounting the right way, you don't worry about the tax side of it. I didn't have 5 on audit. I only had 4. So I had not reporting your income, foreign or personal, not reporting income, foreign accounts, excessive business tax deductions, the ratio stuff, and the high earners. They only had 4 examples of 4 when I looked it up. So while we just spent an hour and a half, an hour and 40 minutes talking about audit red flags, the odds of the audit are incredibly small. And as long as you're doing what you're supposed to be doing, and you have the documentation, you really have nothing to worry about. You really don't. The only time you have to worry is when you're not doing what you're supposed to be doing. So that's that. Are there any other questions? We're going to go raid pretty soon. I'm going to go get ready for my show tomorrow. I've got most of you guys like primitives. We're doing primitives. I got a video in the show. If you open up the show, you'll see a little video. If that's your vibe. The money is not available to me until I reach 1K sales. Do I have to file money? I don't have. No, you do not. If you're cash, you do not have to include that on your tax return. You include it when you get it. And actually, the money is available to you before 1K. So, Debbie, the way Whatnot works is when you're less than 1K, you don't get the money when you create the shipping label. You have to wait until the customer gets the order, and then the money's released to you. So you still have your money when you're less than 1K. It just takes you a little bit longer to get it. Whereas once you hit 1K, you can make that withdrawal of the money as soon as you create your shipping label. So until you get to 1K, it takes you about an extra week or so to get your money, but you have access to it eventually. But as far as taxes go, you don't claim that on your taxes until you actually pull it out of Whatnot and you have that money in the bank or in your hand. Thank you guys for being here. As always, I appreciate all the questions, the interaction. It would be pretty boring if I just talked the whole time. So thank you so much for asking questions and making comments. And thank you to anybody who just lurked in the background and listened, because every single one of you are important to the show. We are going to go raid somebody, and that my husband gets the honor of picking who we raid. So who are we going to tonight? While he's looking for a raid, let me tell you guys about the workshop on Monday night. We are in week 4. I'm going to pin it here really quick just so you can see it while he's looking for a raid. So I have been doing setting up your reselling business workshop. Oh, are we out? Are they're not here? Oh, here it is. Setting up your reselling business workshop. We are on week 4. We're going to be talking about shows 2 and beyond. We have gone from how to set up a bank account to how to set up your accounting to how to run your first show. And now we're going to talk about shows 2 and beyond. We're going to dig into analytics Monday night and start kind of talking about that. The course down here gives you access to all 4 weeks of those Whatnot videos, along with participant guides for each week, supplemental material for it. So it's a really great investment. It is tax deductible. And if you're on the fence, you're like, hey, it sounds cool, but I'm not sure what you talk about. Come Monday night, check it out, and hear what we have to say. Also, if you're interested and you're like, look, I just can't afford it, Monday nights are free on Whatnot, and you can ask as many questions, and I try to stay as long as I can. Last Monday, we were on for 3 hours answering questions. So hopefully we'll see some of you on Monday. Who are we rating?
I'm going to take you to see a mountain and a waterfall. How do you like that?
Sounds good. Let's go. Thank you so much, Reclaim Relics.